The market is crashing. Headlines are screaming. Investors are panicking. But what if this is actually your biggest opportunity to build wealth? In this video from Wealthsprint, I'll show you why the world's most successful investors see downturns as golden opportunities and how you can do the same, even if you're starting small. This is based on real data, proven strategies, and the mindset of people who win long term. Let's be honest, most people don't know how to react when the stock market crashes. They check their portfolios, see red everywhere, and the instinct is to sell before it gets worse. It's an emotional response. And it's exactly what the majority does. But here's the truth, selling in a panic almost always locks in losses. The people who panic sell often regret it later because history shows that markets recover. Always have. What separates successful investors from the rest isn't just strategy, it's mindset. And if you're watching this, chances are you've felt that fear too. Maybe you've sold at the wrong time. Maybe you've hesitated to buy when prices dropped. You're not alone, and you're not failing. You just haven't been shown how to think clearly when everyone else is losing their minds. Think about this, the wealthiest people in history didn't get rich by avoiding risk. They got rich by staying calm during chaos and acting when others froze. And that's exactly what this video is about. You're going to learn how to break free from the panic mindset and start seeing downturns as windows of opportunity. So how do you actually turn a market crash into a wealth-building opportunity? In this video, we're going to break it down step by step. First, you'll understand why crashes happen so you're not blindsided when they do. Then, we'll dive into the psychology behind panic selling and how to avoid it. You'll learn what the rich do differently, how history proves crashes lead to gains, and the exact steps you can take to position yourself for success. And finally, I'll show you what mistakes to avoid and how to build long-term wealth with confidence, no matter what the market is doing. If you're serious about growing your money with clarity and confidence, make sure to subscribe to Wealthsprint and turn on notifications, because these are the insights most people never get. Fear versus opportunity. When the market drops, fear takes over. News outlets pump out worst-case scenarios, social media is full of panic, and everyone suddenly becomes a financial expert. But here's the secret few understand, every crash brings opportunity. While most people rush to sell, a small group quietly prepares to buy. Why? Because they know that panic creates discounts on solid assets, strong companies, and long-term growth. Think about it like this, if your favorite brand suddenly put all their best products on sale, would you run away or start shopping? Market crashes work the same way. They're not signals to flee, they're signals to pay attention. This is when fortunes are built, not when everything's easy, but when things feel uncertain. The key is shifting your mindset from fear to focus. Because opportunity doesn't wait for perfect conditions, it shows up disguised as chaos. Why do stock market crashes happen? To take advantage of a crash, you first need to understand why it happens. Crashes aren't random. They usually come from a mix of factors like rising interest rates, inflation, speculative bubbles, or global political instability. Sometimes it's triggered by fear itself. When investors expect bad news, they often sell based on emotion, not logic. That selling pressure builds, snowballs, and suddenly, the market tanks. But here's the thing, understanding the cause gives you power. It helps you zoom out, see the bigger picture, and avoid impulsive decisions. Smart investors don't panic because they understand cycles. Markets go up, markets go down. That's normal. What matters is how you respond. When you know why a crash is happening, you stop reacting emotionally and start preparing strategically. And that leads us to the next big factor, how psychology can destroy your portfolio if you let it. The psychology of panic selling. When the market drops, our brains scream, "Get out now before it's too late." It's a survival instinct, great for escaping danger, terrible for building wealth. This is called loss aversion. We feel the pain of losing money twice as strongly as the joy of gaining it. That fear triggers panic selling. People dump their stocks at the worst possible moment, locking in losses and missing the recovery that often follows. You've probably seen it happen. Maybe it's even happened to you. Someone sees a dip, sells everything, and then watches in frustration as prices bounce back without them. But here's the truth, markets recover. They always do. And those who stay calm during chaos are the ones who win. The goal isn't to eliminate fear, it's to recognize it, and not let it control your decisions. So now that we understand the emotional trap, let's look at what the wealthy do differently when the market crashes. What the rich do during a crash. While the average investor panics, the wealthy take a completely different approach. They don't sell, they prepare to buy. They don't react emotionally, they stay focused on value. Warren Buffett famously said, "Be greedy when others are fearful." That's not just a quote, it's a blueprint. During downturns, smart investors see opportunity, great companies trading at a discount, assets undervalued because of fear, not fundamentals. They've done their homework. They have cash ready. And when others are running for the exits, they quietly build positions that later pay off massively. This isn't luck, it's strategy. It's about patience, preparation, and a long-term mindset. You don't need millions to follow this approach. You just need discipline and a willingness to act when others hesitate. And if you're still unsure whether this works, let's look at what history tells us. Historical proof: crashes lead to big opportunities. History doesn't just suggest that crashes lead to opportunity, it proves it. Every major downturn has been followed by recovery and often explosive growth. After each bear market, the bull comes roaring back. Those who stayed invested or bought in while prices were low came out stronger. Look at past decades. After recessions, strong indexes and companies didn't just recover, they reached new highs. Crashes cleared out speculation and made room for real, long-term gains. That's how wealth is built, by holding steady when others fold. It's not about timing the exact bottom. It's about recognizing patterns, trusting the cycle, and positioning yourself while prices are down. Because when everyone else is focused on short-term pain, that's when the long-term upside is greatest. So, how do you actually prepare for that? Let's get into the practical steps. Practical steps to profit. Now that you understand the opportunity, let's talk strategy, how to actually prepare and profit during a crash. Step 1. Build your emergency fund. This is your safety net. It keeps you from selling investments in a panic just to cover bills. Aim for 3 to 6 months of living expenses in a high-yield savings account. Step 2. Create a watch list. Start tracking high-quality companies or ETFs you believe in long-term. Look for strong balance sheets, consistent earnings, and durable advantages. When prices drop, you'll know exactly what to buy without hesitation. Step 3. Use dollar cost averaging, DCA. Instead of guessing the bottom, invest a fixed amount regularly. This spreads your risk and takes emotion out of the equation. Over time, it helps you accumulate more shares at lower average prices. Step 4. Stay consistent. Discipline beats timing every time. The market rewards patience, not perfection. These steps aren't flashy, but they work. And they put you in control while others are still reacting emotionally. Now, before you act, it's just as important to know what not to do. Let's look at the biggest mistakes to avoid. What to avoid during a crash. When the market drops, the wrong move can cost you more than the crash itself. So here's what to avoid at all costs. First, don't sell out of fear. Locking in losses only turns paper dips into real damage. Second, don't use leverage. Borrowing money to invest during volatility is a fast track to disaster. Third, avoid financial gurus preaching doom. Fear sells, but it rarely builds wealth. Stick to fundamentals, not fear-mongering headlines. Finally, don't try to time the bottom. Even pros get it wrong. Waiting for the perfect entry point usually means missing the real opportunity. Instead, stay focused on your plan. Crashes are temporary, your goals are not. Avoiding these mistakes can make the difference between falling behind and building serious wealth. Now let's wrap it all up with the mindset that ties everything together. Long-term wealth mindset. Crashes come and go, but wealth is built by those who think long-term. Short-term noise doesn't matter if you're focused on where you're going. And the truth is, most people lose money not because of the market but because of their reaction to the market. Building wealth isn't about being the smartest person in the room. It's about staying consistent, being patient, and sticking to a strategy even when it feels uncomfortable. The chaos you're seeing today? It's not the end, it's a beginning. A rare chance to buy low, grow steadily, and come out stronger on the other side. So, don't fear the crash. Use it. Let it sharpen your focus, test your discipline, and fuel your journey toward financial freedom. Now let's bring this all together. If this video helped shift your mindset even a little, do one thing right now, like, subscribe, and drop a comment below sharing your biggest takeaway. This channel is here to help you grow, not just financially, but mentally. Because real wealth starts with how you think. Remember, every crash is temporary, but the habits you build now can pay off for decades. While others panic, you can position yourself to rise. So take that first step. Stay calm. Stay consistent. And keep building even when it's hard. Because the journey to financial freedom doesn't start with perfection, it starts with action. You've got this. Now go turn uncertainty into opportunity.